Time for some stock strategies and investment strategies for 2012. In segment one, we looked at a broad market outlook. Steve, drill down for us here.
Yeah, as far as the strategy, I'm looking for, say, 15-ish% upside on the market from where we stand today. But I'm not going to say for a second that's going to be a gung-ho, straight-up kind of market. I mean, I think, Shiraz, you said earlier that you were expecting some market volatility in the first quarter, first half of the year, not unlike we've seen, and I'd say that's probably true. So, you know, what the strategy that won in 2011 was boring, large cap stocks, safety, dividends, okay? A little dose of that isn't bad, to have a third, a half of your money in those kind of things. But you got to take your shots. There is going to be growth out there, in particular if you're focusing on companies whose strength is selling products and services in the United States. Recently, I've added some retail stocks, you know, that are focused in the United States. And also regional banks, okay, because they don't have as much of a problem in terms of the derivatives, the foreign bank exposure, the foreign national debt. So those are some groups that I happen to like, but also natural resources.
Absolutely.
The demand for oil is not going away. I know you've been a big fan of that play, and in that I like carbon ceramics, and so we'll put up the chart for that one. And so there's some hubbub about the fracking practices. That is all pseudoscience.
That's right.
And,
it is.
And that's Ma and Pa out there with pitchforks yelling about the poisoning of the well water, which, according to the science, has been in Wyoming has been poisoned for 50 years. And they just finally noticed that the last 5 years of fracking has nothing to do with it. So I think that's created some downside pressure on the stock, which is a buying opportunity for the long haul.
All right, and so you like domestic demand in the U.S., though? That's
domestic demand in general, but still I'm a natural resource fan, particularly oil. Carboceramics is a nice way to play that.
All right, Shiraz?
I see a continuation of what we have seen over the last 2, 3, 4 months into the first half of 2012, which basically means that the buy and hold type of a strategy is not the best way to go in that type of environment. So more tactical allocation, moving in, moving out of stocks, and being relatively defensive, more quality-oriented stocks, even if it's across the board in different sectors. So quality names, solid balance sheets, maybe some defensive attributes in the business, dividends in the first half. But then you have the picture relatively clears up on Europe, on China. We continue to muddle along. As I said, I agree with Steve's outlook for the U.S. economy, and that gives a push to relatively more cyclical names. I would like to have some industrial names. I like energy, the other resource companies too, and I also like regional banking and some selective picks in the banking and the broader finance sector. Consumer is not dead. My pick in that is Polo Ralph Lauren. It's a quality, high-end retail theme. The European exposure weighs on the name a little bit, but they have a huge expansion coming through in Asia, which over the next 2-3 years would basically give them a one-third earnings exposure from Asia, Europe, and North America.
Good exposure to have.
That's right. And in terms of the cost inflation, they have the brand presence, which gives them the pricing power. We have seen that over the last couple of years, and I see that continuing into 2012 and 13.
And so let me get this right. Do you say that we can get cyclical again in the second half?
That's right.
Okay.
I'm very careful in the first half. You want to have defensive attributes, quality names, and once some of these macro clouds clear up, which I'm looking forward to by the end of the first half, then you move into more cyclical theme names, and that's my outlook.
Okay. And on the defensive blue chip dividend payers, you like the idea of trading in and out of them. So say if you get a 20% gain in one, you let it go?
Yes, you have to.
Yeah.
This is the nature of the market that we have seen in the last 4 to 6 months.
Right.
If you just held on to a theme that you created in the beginning of 2011, it wouldn't have worked.
Right.
So more tactical strategy would
Take the
be
gains and give up the dividends that
That's
quarter.
right.
Okay. Kev?
Retail probably would have worked, though. If you just bought and held retail, you probably would have looked like a hero. So I second that, and I do think high-end retail is going to be a fantastic place to be. For me, I also agree that you have to be flexible. This buy and hold kind of thing you probably just can't do. But the three sectors that I am targeting, the first one, believe it or not, is construction and real estate. I think
we found the bottom?
Yeah, well, I think that we're
Kevin
pretty,
has.
I think we are close to it. If you were to take a look at the home builders, you have a lot of fantastic bullish chart patterns out there. Earnings estimates are on the rise. I mean, earnings in absolute terms don't look that great, but they seem to be better than the dismal expectations from the past. And if you were to just take a look in aggregate at a lot of these real estate investment trusts, you can see that a lot of these companies are trading near their 52-week high. They're breaking out to new 52-week highs. I think these are great places to be. Also, too, the world is a difficult place. There's not a lot of great investment opportunities, and I think you're going to see a lot of foreign investors shunning a lot of the emerging markets. They're going to come into the U.S. and they're going to be snapping up a lot of U.S. properties. So I think that is my top pick, and let's review this in 2012. At the end of 2012, I think this is going to be one of the best performing sectors. I also believe transportation and business services is a good place to be. If you believe that the U.S. economy is getting better, you have to look at business services, especially the way that they implement technology. That's one of the ways that businesses have been able to increase their gains over the past couple of years. So I think business services is a great place to be, and transportation, specifically the intermodal and truck areas of the transportation. I think that is a fantastic place, and that also leads me to my stock pick. One of them is Dorman Products. That is ticker DORM. They do a lot of OEM parts, and they're a big participant in the aftermarket. Not only do they do automobiles, but they're also heavily involved in trucks and this kind of stuff. What I really like about them, and I think this is a broad theme in general, they don't have any debt. So they have no debt. Their margins are 2 times better than the industry, and they've got some pretty phenomenal growth rates. And I think that this is a great place to concentrate. If you were to look at them specifically, I have a price target of $52. For the end of the year, I believe that they have the potential of making a 31% increase.
All right. Now my turn. All right. I'm focused on 2 sectors for the coming year, and that's energy and biotech. Just because with biotech is not as economically sensitive. You get a story there that works and a product that works. For example, I just had a great trade for my new service technical trader last week in Vertex. Yeah. This is a stock that was just beaten down because all of a sudden they make a hepatitis C virus vaccine, and so they've got this new drug. They're expected to do $2.5 billion in sales next year, and the stock went down below $30, trading at under 10 times next year's earnings, just because there were competitors coming out. Gilead Sciences bought a Hep C smaller biotech and paid like an 80% premium for them. So everybody thought, well, that's going to be the go-to company now. But it turns out that company may have some problems. So Vertex seems to have made a bottom here at $30. I like it. For the better part of next year, going forward from here. Energy, I think last week I looked at National Oil Well Varco. I think they're well positioned. They're onshore, offshore, equipment services, and oil field services. And that's the kind of exposure I want to have. You could also look at a Baker Hughes or a Halliburton, because these companies are going to continue to do business, especially when you have all this expansion. They talk about tight oil. That phrase in the industry doesn't mean tight supply. It means getting the oil out of hard-to-reach places, right? Like the shales. This is a booming thing, and we joke that North Dakota is like the fastest-growing economy in the world because of it. And you talked about fracking earlier. This is what's going on. So the service companies, equipment makers, and oil field services are going to be strong. So I like those going forward. And just I also want to look at gold at some point here. I think if gold really gets hammered and we take out all the weak longs here who want to take their profits, and if you see a 1,400 handle on gold, I want to be a buyer of gold there.
14, huh?
Yeah.
Not 16? 14.
Hey, we're trading 16 right now, but I think there's more pain to come in gold. Guys, any precious metal thoughts here? Risk of
I have been bitten so hard by the gold things that I tried to stay away from it. I missed the entire upside and kept denying it, and I want to stay away from it. Yeah.
I mean, how useful is it, right? You know, you're banking on the failure of banking, so to speak, right? As long as quantitative easing is going on and you're printing money, you know, should gold have a monetary value?
I would just say plain and simple, the big money has been made since 2002. There was a big run up here. The investment potential of gold is not that exciting anymore, but if you want to, as a safety margin, if you want to have 5-10% of your money in gold, that's always relatively a sound idea. But the idea that it's this great way to beat the market right now, I think that party might be over.
Yeah. Last thing I want to close with, Kev, you mentioned foreign direct investment, possibly coming here, scooping up some real estate assets. China just launched a new sovereign wealth fund with $300 billion. They're going to be looking at hard assets. So even if emerging markets are weak, China is still the engine.
Right.
All right, thanks for hanging with us for our 2012 outlook, and we'll see you next year.